Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager, as per usual. So thankful you clicked and given us a few minutes of your time. I do think we've got a really good version here for you today with some really big, important stuff. And as opposed to kind of looking at kind of micro level, directions of the current market and or economy where we're going. Instead, we're kind of taking a look at some big picture asset allocation and some longer term projections. So sit tight here. I think we've got some really good information for you. We're going to talk about balanced portfolios and how they have returned versus inflation, what that is in context of historical returns. And then Andrew's going to talk about really Goldman Sachs forecast that made a lot of waves, got a lot of attention, and I think really triggered some healthy discussion. And kind of give you some positives and negatives out of that and some ways that we're thinking about it. So let's just jump right in and talk about the balanced portfolio versus inflation. So we're going to throw up a chart here. And by balanced, in this version, we're going to talk about it being 50% stocks, 50% bonds. So typically we think about 60 and 40, but for this version, it's based on a JPM study that we'll get to in a second. So we're looking at 50-50. And the return going back to the peak in late 2021 is in the purple line, and you can see it has returned a positive 9.91% since then. Of course, we had the big drawdown, but has recovered that and gotten to the positive side and then some. However, inflation is the orange line, and so inflation has surged above 12%. So when you're looking at on a real return, which is what matters to you all over time, because that's what your money is after inflation has taken its toll, is actually still a little bit negative, but is coming close to really creating a milestone in this recovery and turning to positive return. And as we take a look at the next chart, we'll show you why that's important. This is a JP Morgan chart looking at a variety of timelines. I shared it several times during the past. I think it's one of the most important charts that we have on file. And we're specifically going to be looking at that second grouping of numbers. It's a 5-year rolling average. The green are showing you equities, and the blue is at bonds. And so we're looking at all the range going back to 1950, every single rolling 5-year period. Stocks have had a wide range. You've had anywhere from a positive 28% to a negative 3%. So in other words, over a 5-year period, even after inflation, the real return for stocks has been negative, and the same for bonds. But when you put them together and you have a 50-50 balanced approach, that's the gray line. And going back to 1950, we have yet to see a 5-year period where an investor who split the money between those two actually had a negative real return. So the significance here to us has always been we have seen the worst route in the modern era by far on the bond portion, that 50% of it. So if we were to recover this again and keep this historical trend intact, that would be good and instructive. And I think rewarding those disciplined investors who can take a longer term approach. So kind of looking into the rear view and where we're at now, I'll pass it over to Andrew and talk about the big Goldman report.
Yeah, thank you. So Goldman Sachs research team put out a report that started getting a lot of attention. What this report does, and it's something many of the banks will do, is looking at what their forecast for the market will be over the next 10 years. We often see banks will say, here's what their end of year price targets are. And that's not something really at FEG we take into a lot of consideration. We often notice that those price targets often move as the market moves, as they simply just chase the S&P 500 up and down. What was interesting and what stood out about this recent Goldman Sachs study was the analysis that they did and the result they found, or the conclusion they came to is probably a better way to say that, is looking at out 10 years, their baseline is that we're going to see annualized 3% growth for the stock market for the S&P 500 over the next 10 years. This is a lot lower than what we've been experiencing recently. On this chart, you can see a distribution of all the previous 10-year rolling returns going back to 1930. And you can see on average 10-year rolling return is 11%. So that's including dividends, a pretty healthy return. What we've had over the last 10 years, so 2014 through 2024, has been actually about 13%, so above average. So what the bank is suggesting is that because valuations are very high, because market concentration, a topic we've discussed quite a bit, among many other variables, because of all those factors, they believe that because we've had such strong returns over the last 10 years, that we'll also start seeing a little bit lower return over the next 10. Now, what that means when they say baseline of 3%, you can see there that they have a range of -1 to 7, in the middle being that 3%. That means that you could have an average over that time frame. It doesn't actually mean every year is going to be 3%. We could have still some very strong years of 15, 20%, and we could have some bad years that balance out to an annualization of 3%. And so we think this is important to recognize. And they also, in the report, also gave some bright spots. It wasn't all just that we're going to have expectations of low returns, thank you, goodbye. But if you see on the next slide was another chart they also shared. So their expectations, because we've seen cap weighted, those mega cap stocks, if you've been watching the market cover for any period of time this year, you've probably heard us talking about the Mag 7 or the FANG stocks, how these mega caps really have been driving returns for quite a while. Because of that, it stretched the proverbial rubber band of just the mega caps have really driven the market higher. And now that rubber band's really stretched. And what Goldman believes and what their forecast and prediction is that we see a reversal there, that we start seeing an equal weighting of the S&P 500 start to outperform against the cap-weighted version. What that means is it provides more opportunity for other stocks to really start driving returns and showing good performance. This gives those active managers or active investors more opportunity to start seeing potential risk-reward opportunities in the market as more and more stocks begin to lead the charge higher, hopefully, in the stock market. And it's not just a concentration of just 5, 6, 7 names. So they believe that what this chart's showing here is that as that blue line goes down, it's showing that equal weighted stocks are underperforming the cap weighted version all the way down to where we saw in the 2000s. And they're expecting over the next 10 years to see that revert higher, where equal weight they forecast to outperform by 8 basis points. And so that doesn't necessarily mean that one is going to be up and one will be down. It just means they think that we're going to start seeing a broadening out and more stocks will be participating and leading over the next 10 years, which we believe is actually a very healthy and market positive, something that we're encouraged, we hope is actually come to fruition, as that provides more opportunity for active management, what we do here at FEG.
Yeah, absolutely. Couldn't have said it any better myself, and something that would be truly good for all of us. So thank you, Andrew, and thank you to all of you for giving us your time. We sure do appreciate it. As always, if we can be of service, don't hesitate to give us a call, 800-928-4001, or scan the QR code and book it electronically. Thanks again, and have a great weekend.